We're back on 76 Research. Oh my gosh, it's been a little while, but I was out of the country and this, that, and the other, but we've been still corresponding. Have we not, Rob, with all these quick takes and 76 Research reports, and we've been staying in touch with people, but it's been a little bit since we've been back here on YouTube.
Yep. Nice to see you, though.
Yep. Good to see you. Listen, we got a market that's pretty darn volatile. I was looking through the numbers. I mean, I was sort of living and breathing it with you on Friday, and I know we had a note out to subscribers at 76research.com, but basically we saw a Dow that traded off, and I mentioned this because this is the headline number that the mainstream media just loves to cite, off 715 points, but that actually wasn't the worst of it. That was down 1.7%. You had the NASDAQ down almost 3%, down 2.7%. And then you had the S&P, which is really one of the best barometers in the market, down 2%, a loss of about 112 points. So I went in and bought. But, I got nerves of steel. I think you were doing a little buying too. Our piece on Friday that we sent out via email, again, people can sign up for the email at 76research.com. I encourage you to go there, 76research.com. A lot of this information is free. We're happy to sort of provide you with some of these insights here. But, it feels, dare I say, a little bit overblown. Like people are getting caught up in the moment. And I suspect, Rob, they're going to get caught up in it just a little bit more as we go into the week because, Donald Trump is talking about more tariffs. And that's just sort of the name of the game right now. Tariffs, tariffs, tariffs. And I think it's scaring a lot of people. By the way, I just want to say welcome to Peace of My Mind. We love seeing you. This is like your own session here, Peace of My Mind, because this is such a little channel still at this point, and we encourage anybody who has questions, etc., to join the community. But what was your take on Friday, and how do we think about it going into the week for investing right now?
Yep. So the big focus of the market now is on what Trump has called Liberation Day, which is Wednesday, where really it's kind of the tariff deadline. And we're going to get more clarity on what where they're going to land, what the levels will be, which countries will, what tariffs will be applied to which countries, which products. So there's been a lot of uncertainty around that, and the market, narrative or dialogue or discussion has really obsessed over tariffs over the last few weeks, and that's been, really what's been a major headwind for stocks and driver of the negative sentiment that we've seen since basically mid to late February.
I don't want to oversimplify it. I really don't. But, I do think that you have to be able to cut through the noise here. And the noise is the mainstream media. There's a lot of bias. I would, a little bit less so on Wall Street. I think institutional investors are big boys and girls, and they kind of get like which way the wind blows. So they may actually welcome some of this volatility, frankly, because, every trader I know loves the volatility. That's how you make money in this business. But I suspect that the mainstream media is kind of leaning into this in ways that are not necessarily conducive for smart investing on behalf of retail investors. And I look at some of the sentiment that I'm seeing from retail investors, and I think that does reflect some fear, some nervousness. And I get it, but look, at some point the tariff thing is going to get settled out, and I think there's a lot of noise and bluster and et cetera. And then, both from, I love Trump, don't get me wrong, you know that, but, there's a lot of, oh my gosh, I'm going to now tariff Russia at 50%. And does he really mean that, or is he just saying that? Is this posturing? I think you have to understand that nuance, and I get it. It's tough for people to make big commitments in light of that. But simultaneously, Rob, I'm not betting against the US. I'm not betting against him. And so I look at this as an opportunity to buy things at better valuations. Let's be honest, things had gotten kind of frothy.
Yeah, and you mentioned, kind of retail. It's interesting. What we really see this year is let's just take a step back and put it all in perspective. So the S&P 500, it's down about 5% this year. The NASDAQ Composite Index, which is tech heavy, it's down about 8%. And let's put that in context. Last year, the S&P was up 25% and the NASDAQ was up like 30%. So, it's not, let's just start there. It's not really the end of the world. I know a lot of people that I've been speaking to lately are very, very jittery, but, this is a bit of a pullback, and actually, something we've been talking about really since we launched 76 Research is the level of, concentration of the S&P 500 in the Mag 7, and which has been like 35% of the index, and the kind of maybe stretched valuations of the Mag 7. Well, so far, in 2025, it's really been the Mag 7 that's retreated. And I think on average, they're down like 15% year to date.
Yeah, incidentally, which is perhaps why, and not to have a shameless plug, but Rob and I do have 3 investment newsletters or model portfolios, you could call them, a growth one, inflation protection, income builder one, and they've all beaten the S&P, in part because we quite deliberately tried to sort of think about companies. I mean, some of them are in the S&P, but maybe that weren't as completely reliant on Mag 7. I know that we recently published, and I won't totally give it away, but we did add a pretty important tech company that we thought that had just gotten beaten down so much to the American Resilience portfolio. I encourage people to go over and check out the portfolios there, 76portfolios.com. But there are a lot of reasons, I think, for people to be nervous. This volatility is probably gonna be here. My expectation is certainly for the next month, maybe the next couple months, but a piece of my mind saying like, look, is this a bargain time? It's hard to call these things, but again, I go back to this. If you need the money next week, right? This is not for you, but if you're a long-term investor and you have a few years on your horizon, I actually really believe that we're on the edge of some massive stuff from the AI perspective, from tech, from a crypto perspective. And I know, because I know you well, and we put out a lot of newsletters, you agree with that sort of foundation of a massive shift happening right here. And so peace of my mind, like if you got the time, like I think that this is a really good opportunity to start sharpening your pencil and look for those good solid companies that are going to get you through.
Yep. And, particularly when it comes to tech, that being the sector that's really faced the most headwind so far this year, and where I think retail, you really see this as a retail phenomenon in the sense that they're the ones who kind of piled into a lot of these sort of flashy tech companies and the AI theme, and now perhaps they're pulling out. And it's interesting, because you think about like if the market were in such bad shape, other sectors might not be doing too well. But actually, like you look at like the value index so far this year, it's up modestly 1.5%. So the sell-off's really been tech focused, and I think a lot of that is sentiment driven over the past few weeks. But all of those things that investors were getting excited about after the election and at the beginning of the year,
right? Because they're like, okay, this guy, he actually understands tech, believes in tech. He's got Elon Musk right by his side. And the goal is, right, to make sure that we are the tech capital of the world and that we are first to market in a lot of these things. And you need to have somebody that, and I'm not saying that Donald Trump totally like is knee deep in this stuff, right? I mean, he's a real estate guy, but he respects, shall we say, entrepreneurs who do understand this, and he's behind them. And I think that that's really, really important. I don't know as you got the respect from the likes of Biden. You definitely weren't going to get it from Kamala, not to get too political, but here, take a look at the PCE. And this is what we wrote about on Friday at 76 Research. Again, sign up for the newsletter, guys. Use my code DOLLAR, DOLLAR. So there's just $1 a month. You can cancel anytime and no skin off your back. And I think you can swing $1. Anyway, it goes up to $9.95 after the first 2 months. But this PCE indicator, it's an important inflation gauge. The Fed loves this thing. This is their most sort of prized inflation gauge, personal consumption expenditure index, and it came in a little bit hotter than expected. This doesn't entirely surprise me. I got to tell you, the last couple inflation reports, Rob, I'm like, seriously? Like inflation's coming down? Like I didn't anticipate that because I feel like these animal spirits are getting kind of unleashed, maybe tempered a little bit by the tariff stuff, but there's all this optimism, right? So what would actually be bringing inflation down other than, yes, there's a willingness to go out and drill, and if you bring energy prices down, that helps. So what's going on with PCE? And I realize that there's some breakdown in terms of Democrats versus Republicans and how they feel about this, and we can get to that. But in terms of inflation itself, is this kind of a one-off, or is inflation going to be the hardest thing that Donald Trump has to fight?
Yeah, I mean, look, so what really kind of triggered the market sell-off on Friday was this PCE number came out, and the analyst consensus was something like 2.7%, and it came in at 2.8%. So there's always a fair amount of noise with all of these estimates, and no one can perfectly get it right.
And
So
revisions
and all that. So it was a little bit higher, and the market didn't like it, and that really led directly to the stock market sell-off. What I noticed though was the bond market took it in stride, and I think there's just a big gap in terms of like what the average person is thinking about inflation, or what even jittery stock market investors are thinking about inflation, and really where bonds are pricing in inflation.
We've got a good chart that we want to show folks because there's bond expectation overall, but like I'm looking at the 10-year right. The 10-year yield is 4.23%. I mean, I remember when it was like 4.9. So that's kind of an interesting indicator. And then there's this, 5-year expectation. Walk us through this chart, because I guess what the bond markets are telling us, and this is really important to think about because I get it. People freak out. The PCE index is a little, hotter than expected. Everybody sells off. Maybe this was the excuse they needed going into the weekend. But the bond markets are actually really the ones that are putting real money on the line. And if you look at this chart, and again, I think you should walk us through this 5-year forward inflation expectation rate. What it's showing you is that people aren't terrified of inflation right now, not in the bond market. I mean, it's ticked up a little bit if you look at that tail end, but it's not awful.
And that was more just in recent, not necessarily Friday, but in recent days or last week or so. So just to give people context, it sounds complicated, but it's a pretty simple but really interesting metric. This 5-year forward. It's what everyone on Wall Street really uses to figure out like what is the market saying, what is the bond market saying in terms of future longer term inflation expectations. Mm-hmm. So it represents it's like interpolated from the TIPS market, the Treasury inflation protected securities market, and it's just inferring what the market is saying the future inflation rate will be. So it's like, what is the market saying that the inflation rate will be 5 years from now for the next 5 years on average?
Okay.
So it's a great metric. It's just the market saying this is where what we think future inflation rates will be, and I think that number's around 2.15% at the moment. It's towards the low end of. Yeah, it's towards the low end of where.
Hey, we had 9% and change once with under the Biden administration. But this is what's fascinating to me, okay? So just everybody remember that, right? Listen, you know where my bias is. Maybe you know where Rob's bias is. But as an investor, like you kind of need to leave that at the door because you just want to make money here. So I think it's important to remember that because the next chart I'm going to show you shows you the Democrats versus Republicans and their inflation expectations. And so just remember that 5-year chart, right, of where the sort of thinking is on Wall Street, where it's going to come out around 2.1%. Like that's livable, right? Like that's what the Fed wants. And yet the Democrats, whoa, Rob, look at this. This says that the whole story. I mean, the Republicans think like inflation is going to be nothing. And Democrats actually are looking at 6.5% inflation. They think it's going way up.
And it's really gone that Democrat reading has really gone way up this year. Right. And so, I think a lot of that has to do with the fuss that's been made over tariffs and the potential impact of tariffs on inflation. So, and that's really also feeding back probably into stock market sentiment and retail investor sentiment.
Okay, so but this is why, like retail investors, I say this, and it's partly why I started this company with you.
Yep.
I feel like, and listen, my whole career at CNBC and Bloomberg less so with retail investors, but certainly retail investors are watching CNBC, and it's like they just always get it wrong. And by the way, I've worked at NBC Nightly News, and I've been an analyst at World News Tonight on ABC, and I've been a business reporter at CBS News. So I've been there, done that, and I know this sort of like hysteria. I can remember early in my career at NBC, actually as an intern, believe it or not, back when Tom Brokaw was anchoring NBC Nightly News, and I worked on the business team, and it was like, boom, the market was off 500 points. Not back then, it was like 200 points, right? Because you're talking about different numbers. The market, Dow closes down 200 points. It was all hands on deck. We were leading the nightly news. And you get, right, how they like to feed into that sort of, if it bleeds, it leads. And so when you have a huge sell-off, that's what actually dominates. When the market's higher, like nobody cares. We wouldn't get the call like you're the lead on the nightly news tonight. But when the market sells off, they're about that all day long. And so one of the things that I always find sad is that retail investors kind of get caught up in that. And I tell people all the time, like turn CNBC off, turn all that like noise and Fox Business. Look, I've been part of it. I get it. Like when the market's doing something, you're all over it. But I just think it's important to take a step back. And this chart actually really saddens me for a lot of Democrats, again, going back to this, because they just don't get it. They're so embedded with their political beliefs. And this is like a recent thing, right? A recent thing that's happened in the last, I don't know, since Donald Trump came on the scene, right? 2015, where Democrats just want to hate on him. And I'm like, you guys are missing out on opportunities. And this is what this is telling us. They're just so freaked out and so scared. And it's too bad, because that's not actually, Rob, to go back to what the real numbers say, that's not really where inflation is, nor where it's expected to go.
Yeah, but if you're bombarded by guests who come on and make kind of really exaggerate the extent to which potential tariffs could feed back into inflation, like it makes sense that the average person consuming that content, consuming that media, is going to think we're headed back towards a very high inflation levels.
Not average though, just Democrats. That's what's funny to me.
The average person who watches that still shows.
Well, that's actually really interesting. That's a very good point. Because if you're watching the conservative media, maybe you're getting a more balanced approach when it comes to some of the economic stuff. Maybe you're actually hearing that some of this stuff is actually really, really good for the economy. You look at, for example, Elon Musk's interview that he did with his whole Doge team on Brett Baer's show on Fox, and that was important for people to hear, because I think all this wasteful spending, it can't continue. I mean, these deficits are sort of out of control, and I think that that's going to be one of our biggest challenges, right? Getting those deficits under control. And if America buys into that, and I think they really do. I mean, especially when you hear about the $2 million going to transgender surgeries in Peru or wherever it was, or the transgender opera in Colombia, or the DEI musical in Ireland, you're like, whoa, I mean, that's a lot of money that USAID was dishing out. And so that's just the tip of the iceberg, though. I think that there's a lot of opportunity there to do spending cuts, and they got to get it under control. It's what Scott Bessent, our Treasury Secretary, has said. He was recently on the All In podcast, great podcast, by the way, that deals with a lot of these business issues, and he talked about that, and he means it. And I think that's what's really going to probably, if they can fix that, Rob, like this administration will go down in history as being one of the most extraordinary, because that's a huge, massive sort of albatross around our neck.
Yeah, and you mentioned the 10-year Treasury, and it's drifting lower than where it had been, and that's because we are taking steps through Doge and through the administration's commitment to bring down government spending. The reality is we can't just sit here forever and spend $2 trillion a year more, at the federal level than we take in, and that just leads to a snowball of debt, which is what we've sort of like. It all kind of really took off under COVID, and then we've kept going, and now the market, as Bessent has said, is kind of, or the economy is a little bit addicted to all of this extra government spending. but it's unsustainable. So it has to be brought back under control, and that'll bring down interest rates.
I think one of the other interesting things that they're trying to do is they're really trying to shift things away from being a government sort of boost to GDP. Because if you look at those GDP numbers under Biden and you look at how much actually he was spending, even in the run up to the election, to kind of goose things for government, it's like, okay, so your GDP number looks a little bit better, your hiring number looks a little bit better, but it turns out all those jobs are being created in government. And then we find out nobody's actually going to work, right? They have these empty buildings and nobody's showing up. And, I mean, come on, like, wouldn't you rather have those jobs being created in real factories or in real companies or, I mean, anywhere but government, frankly?
Yeah, we need to see a rotation, and this is what they're focusing on, a rotation away from all the resources of the economy being consumed by the government and shifting it back to the private sector.
It matters.
Yeah. You made the point.
Go ahead.
You made the point, like, if you just kind of rewind, actually, remember last summer, August, September, we were looking at some kind of economic weakness, and that's when the rate cuts started. And then sort of as we went into the election, things started like looking a little stronger with the economic data. And yeah, maybe like some of that was, the federal government under Biden kind of turning on the spending and injecting cash into the economy via federal spending. So I say all that as a way of kind of interpreting where we're almost kind of getting back to that kind of little bit of like that recessionary impulse or kind of economic weakness that we initially saw about 6 to 9 months ago after that post, that sort of election surge.
The surge. But I think that, you just can't spend like this and expect to have, any kind of future. Here's let me see if I can pull this up. One of the Doge team members talking about this, Rob, and I found this pretty fascinating. He's like, look, it's just not sustainable. He's doing an interview here on my former employer on Fox. Let's take a listen and react.
The cuts that Elon Musk's Doge committee have made because they are substantial. He says it should be fairly easy to get to $1 trillion in government spending cuts. Do you agree? That seems like a huge amount of money.
John Scott, it's great to be with you. I think it's a good start. It's a good start. And the more I watch your coverage of just people having a meltdown, where you've got Elon and his team working to find waste, fraud, and abuse. Who could be against that? And it seems that just misinformed people don't understand how fragile our government is, how our government can't pass any type of reasonable audit. So we support a complete review of how we spend money, the process of which we do so. It's long overdue. And to the American people watching right now, if we don't, we will go belly up sometime in the near future.
I believe one of the items that caught my ear is when the Doge committee announced there were 1,800 people at the Social Security Administration whose job it is, their only job is to hand out iPhones to various members of Social Security. And they indicated that they could do 2 of those a day and cover, each person could hand out 2 phones a day and cover the entire workforce. It seems like an extraordinary amount of waste.
It is an extraordinary amount of waste, and the spotlight is being shined. And again, I'm still trying to grasp, John Scott, who could be against waste, fraud, and abuse to preserve our way of life, to preserve the promises. Our country has made so many promises to seniors, to veterans, and this is our way of getting financially healthy so that we can make those promises. I think it was at the IRS that has those 1,400 employees that their only job is to give out a cell phone or a laptop, and they could do it within a month, yet here we are. John, you have to remember, too, the Biden administration added over 200,000 federal employees. It was one of the largest growths of our federal government since the 1800s. So they're only they're right sizing. It has to be done. Has to be done. Sometimes it's when you go through change is not easy. But in order to get healthy financially and otherwise, we have to do it.
Yeah, I mean, and forgive me, that wasn't one of the actual Doge guys on Elon's team, but rather one of the committee chairs there in Congress. I mean, it's amazing. This is like a fundamental difference, though. Unfortunately, I think between the left and the right now, it hasn't always been this way, though. And I just want to emphasize that, because I was recently looking at some video of none other than Barack Obama, who was going on and on and on about the importance of cutting waste. And I found that quite striking, because I was joking, and this is on my other channel, on the Trish Regan show, we put it on the shorts feed. I was like, man, like he could get a job at Doge now. Like, they talked a good game. This really shouldn't be partisan. It's all about sustaining ourselves. Heck, Clinton, with Gingrich's help, right? They were able to zero things out. I don't know why there's such a resistance to this. They're suing everyone they can think of, saying, no, you're not allowed to cut anymore. And it's like, guys, if we don't, like, what is the end game?
Yeah, I mean, Clinton's presidency was really premised on, having smart, efficient government and fixing kind of welfare, right? And the Democrats had a pretty good formula. And I guess Obama at some point tried to carry on that legacy, or was interested in those talking points. But
either that, or he just wanted to get rid of everything that Bush had created.
That's the fair. Yeah.
Right? I was thinking about that. I'm like, why would Obama be all for cutting expenditures? But Doge is working to reduce deficits in ways that I think are really, at this point in time, totally vital to our future.
Yeah, and I think one of the most interesting aspects of it is kind of bringing current technology and advanced way of thinking about cost control, like what Elon does in his companies, bringing that to the federal government. Just even as simple as cross-referencing the databases. Some of those numbers were really astounding in terms of the PPP loans that were given to children or babies, and just because of the weak IT systems that we have within the government. So it really does need to be modernized, and there really is a tremendous amount of waste.
I want to get to tariffs, because tariffs is something that is really scaring a lot of folks right now in different ways, and obviously probably more folks on the left than on the right. He's talking about really changing sort of our system overall, not just like reducing deficits and like getting our spending under control, but he's also looking at what's fair. And if we're sending things overseas to Europe and they're charging tariffs, and yet they're sending stuff here and we're not charging tariffs, I mean, wouldn't it just be better if everybody had no tariffs? I mean, just zero tariffs? We've kind of been in this giveaway. We've allowed them to do that, which frankly put our goods, right, at a lesser shot at being sold overseas. So I think this is sort of about, okay, let's just all be adults here. And if you guys are going to play that game, we can play that too. Today it got ratcheted up, and we'll get to that in a moment, because he's talking about, like, he was really mad. He went on a Kristen Welker's show on NBC and was talking about 50% tariffs on Russia. Before we get to that, tell me sort of, let's discuss, because I find this fascinating, this turning of the traditional economic thinking on its head to say, okay, you're tariffing us, but we're not tariffing you. I don't think that's going to work.
Yeah. Well, the U.S. just has been running these enormous trade deficits with the rest of the world. And a lot of that also relates to the fact that the U.S. dollar is used as the global reserve currency. So, instead of taking our dollars when we send them overseas and then like buying our products, they're buying our treasury bonds or investing in our stock market. Mm-hmm. So it kind of flows back into the U.S. as investment. But the end result of that is this like steady deindustrialization of the U.S. economy and kind of headwind to our manufacturing sector. And
which, by the way, is vital for national security.
Yeah, it's vital for national security, certainly in like a military sense. You want to be able to produce the goods that are required to have an army, navy, and air force. But it's also vital for our economic security. You really don't want to get to the point where you've completely walked away from the manufacturing sector and the commodity sector, and you're just a bunch of banks and tech companies, because that leaves you even economically in a very vulnerable position. So you want to have a diversified economy and a resilient one that's independent and not reliant on other countries, particularly your adversaries like China.
Yeah.
So yeah, this is a lot about, setting up a mechanism that would protect American industry in the context of these persistent trade deficits, which have a lot to do with the tariffs and trade restrictions that other countries impose on us. And a lot of it has to do with, kind of monetary issues. This tendency for people to hoard dollars as opposed to recycle them into trade with us.
That actually kind of brings me to our next thing, but because I'm watching gold and it's like, wow, gold has just been completely on a tear, and you wonder when we talk of, and I guess tariffs are related to this. I'll let you finish your thought, because I actually want to find the soundbite from Donald Trump right now and play it for viewers. So just button that up in terms of where you think we're heading.
Well, just on tariffs, I think the last point is, like, when you impose tariffs, it's basically a sales tax on foreign goods, and it's a source of revenue for the U.S. economy. So in addition to rebalancing the trade flows, it creates a revenue opportunity for our government, which, we're in this context of trying to reduce our deficits, but also it opens up the possibility of tax cuts, right? So you're taxing one part of the economy, imported goods, but that gives you flexibility perhaps to cut taxes on other parts of the economy like income. And in particular, I know the administration's been talking about possibly doing away with taxes on everyone making less than something like 150K or 100K. I forget what the exact number was, but the idea that there's an inflationary impact because you're taxing certain goods, but because you're raising those revenues, you have the opportunity to cut taxes elsewhere.
Right. And it's a rethinking of the economy. And hey, if you can give those tax cuts back to the people, isn't that great? Simultaneously keep a thriving manufacturing industry, because listen, not everybody's going to have a PhD in God knows what, right? And, engineering, let me just say, or rocket science. Hopefully they're not getting a PhD in transgender studies. There's been a little too much of that. But I would just say, like, you have to be able to have a sustainable future for the middle class, which is what drives our economy overall and our standard of living, et cetera. Here's Donald Trump, though. I want to go to him speaking about tariffs on NBC this morning. And he's getting a little bit annoyed, shall we say. Maybe it's posturing. Maybe it looks good to not look like he's doing a deal with Putin. But we can discuss this. I want to show the viewer what Donald Trump said vis-a-vis tariffs on not just Russia, but anybody doing business with Russia.
Just hours ago, President Trump called me to tell me he is, quote, pissed off with Russia's President Putin and threatened to impose secondary tariffs on Russia's oil. Quote, if Russia and I are unable to make a deal on stopping the bloodshed in Ukraine, and if I think it was Russia's fault, which it might not be, but if I think it was Russia's fault, I am going to put secondary tariffs on all oil coming out of Russia. Mr. Trump said 25% tariffs on Russian oil could happen any moment and told me he plans to speak with President Putin this week. The president told me, quote, I was very angry, pissed off when Putin started getting into Zelensky's credibility and started talking about new leadership in Ukraine.
So that's interesting to me. Yeah, I find it somewhat self-serving, or I don't know, like, you go to NBC and you say, okay, whether or not that's actually going to come about, I know it's going to like scare the markets again. And I'm like, I don't know as I totally buy that. It might have been a little bit of bluster. She's making a lot of it, obviously, and very excited. She had this telephone conversation and must have been scribbling it all down and then putting it into a graphic to run on air. But that's actually become quite a lead in the news cycle over the weekend, that, you could see up to 50% tariffs, and not just tariffs on Russia, but anyone who does business with Russia. Again, I'm going to go back to like noise. I don't know. I just think it's a lot of noise. I think you're going to see a deal. He's a good negotiator. I think he wants to make sure that peace does come to. I mean, Elon's commentary the other day, again on Fox, was just, it blew me away because he got back to the reality of all this, which is it's human life. And I think they want to get something sooner rather than later. How do you think about investing in light of talk of more tariffs on Russia, et cetera? I mean, they better have a heck of an energy plan. I put that out if that's the case, because we need these lower energy prices now.
Yeah, and I think it could be, marginally disruptive, I guess, to energy markets, and you could see higher oil prices. I mean, Trump is in a look. I mean, these are two sides that are not really keen to get along with one another. And in terms of negotiating with Putin, I mean, he's a pretty hard-nosed individual and not kind of a pushover by any means. And I guess Trump has been criticized, from the left for being too passive with Putin or too compliant with him, and now he's pushing back. It's a tough deal that to negotiate, but I think the Russians do have pretty strong incentives to resolve this in a way that kind of meets the security needs that they've always articulated. Mm-hmm. And Zelensky, I mean, he's well, I mean, yeah, Putin doesn't want to even interact with him.
He doesn't have a heck of a hand to play.
And we'll see if he is around. I mean, it's not really up to Putin to decide whether or not Zelensky's going to be the one in power, but he might not be forever.
Going back to what's working right now, this is amazing to me. And like, I think you and I have called it. We have been pretty bullish on gold. If you look at our, let's see, inflation protection and the income builder portfolios, we've talked a lot about gold there because we've seen this as an investment that's worth having kind of in good times and bad, right? So this is the shocking news. We were looking at this and we were both like, oh my gosh, like who knew? All you had to do was buy gold for the last 20 years and you've beaten the S&P. Wow, like as of yesterday, that's amazing. So gold is outperforming the S&P over 20 years. That's an incredible chart, just an incredible chart. And it makes me even happier about my gold. Like sometimes people say, oh, don't buy gold. What does it really mean? And that's a fair question, right? In fact, I think we just got something from a viewer, not just a viewer. Actually, this is somebody who is a subscriber to our research, and I want to share this with you guys. I'm not giving his name away, so I don't think he'll be too upset, but he had a really, really, really good question, Rob, and I think it's worth taking a look at. He writes, hey there, dynamic duo. My question is, what is so special about gold? You can't use it to buy something at the store and get change if you use it. And so you have gold. How are you going to use it? Like, how are you going to get money from it to buy stuff? And how hard or easy is it to get money from gold to spend it? Why not just buy king stocks, right? Lots of stocks that get you quarterly dividends. And from that, you're going to be super safe because you've got actual stocks. You don't have to worry about whether or not they drop in price. You get the dividend, no problem. And by the way, we do like that, and we do like dividend stocks. I should point out that in our income builder portfolio, we do have that's a big part of why we created that, as well as inflation protection, because I told you, right? Like I want to make sure we have some dividend stocks in there so that people get paid when things are going down. But back to the question about whether or not it's really worth having gold, and you look at this chart of how it's outpaced the S&P, you can understand people are like, but really why? Like, what is that? And why does that represent value? I mean, it's represented value for thousands of years, of course. Philosophical question that we can discuss.
Yeah, no, and these are debates that, I've always encountered on Wall Street, because you do get a certain type of investor who just really doesn't like gold and looks at it and says, what is it? It's just a stupid bar of shiny metal. Like, what's the point? Why does it have value? And smart people sort of feel this way too. Warren Buffett among them, very skeptical of gold. I think, but then you get other investors who completely get it and have an appreciation for it. So I think that the starting point is to really understand that gold does not have value because of its utility and some sort of industrial function. Gold has value because it's money, because of its utility as money, as capital. And the fact that it's not, the reason it's not useful in a lot of things is that it's a very inert, stable metal and a very scarce and unavailable metal. But those properties are what really make it useful as money. And that's why for, thousands and thousands of years, it has served as money. So in the current context, you've got a lot of central banks accumulating gold, making, particularly in emerging markets, making it their core reserve asset, moving away from U.S. treasuries and the printed money of the U.S. federal government. And that accumulation is really what has driven the price of gold up relative to fiat currencies.
Now, that brings us to an interesting discussion, if you would. So if you think about gold outperforming the S&P over 20 years, what does that mean, right, for the next 20 years? And what does it mean in terms of the U.S. holding that position? Don Bacco, good to see you over here. He's laughing about that. He used to be a trader, and you're at the CBOE, right? So Don is making the comment in our chat here that one of the first things he learned, of course, is that investors are always fearful and tend to act like sheep, right? So you want to try and avoid doing exactly what the retail investor is doing all the time. Good point, Don. But back to gold outperforming here. So if gold is outperforming and maybe continues to outperform, I think that actually speaks to something else, which is that there's this realignment, if you would, globally, where I think a lot of emerging market countries are like, ooh, I don't want to be so dependent on U.S. treasuries, in part because of some of the things, frankly, that Biden did, right, where he cut off Russia and they couldn't get access to any of their dollars because they had invested in U.S. treasuries. So if you're Russia, why would you ever want to invest in U.S. treasuries? If you're anyone, why would you want to invest in treasuries if you're at risk of ticking off the USA and therefore not having access to your money? And I think that's sort of if you're going to be the sort of dominant financial power in the world and you want everybody buying your treasuries, you're going to have to realize that you can't so easily cut them off, at least nowadays, when they have access to gold and frankly, Bitcoin as well.
Yes. And, the beauty of gold, the really neat thing about gold is that, you buy, if you're a central bank in India, China, wherever you are, you buy Turkey, you buy gold, you bring it into your country, you put it in your vaults, it's yours. You're not relying on some third party or some, Western bank to give you permission to own your asset, or, when they decide to freeze it or seize it or give it to Ukraine, in Russia's case, give it to Ukraine to buy weapons to be used against you. So gold it's a non-sovereign asset, and it's unique among all the potential reserve assets out there. And it can't be printed. It can be mined, and the supply growth is 1% to 2% a year, but there's physical limitations on as to how much mining can occur. But it can't just be printed by the European Central Bank or the Fed. So you just have this kind of migration towards gold as a preferred asset. And Bitcoin, you mentioned, it's serving a similar function, but rather than in the physical realm, in the digital realm. But it's not there yet in terms of central banks and sort of it's a sub $2 trillion market cap now on Bitcoin. Gold's more like 20 trillion. Right. So gold's the more established form of money for purposes of central banks, but I think the Bitcoin story really is, over time, this is the digital version of a decentralized, non-sovereign, form of money, a form of capital.
It's really incredible how well it's done. And it's incredible to me how many people on Wall Street resist it. I don't think you'll ever meet a money manager who's like, oh yeah, go buy gold. And I'm not entirely, is that just industry bias and the fact that maybe you don't get something as a money manager? I don't know. I mean, I've sort of struggled to understand why they're so resistant to it, especially now with a statistic like this. I mean, it just seems like in a diversified portfolio, this would be one of the things that you would want to hold.
Yeah, and gold's up 17% or 18% year to date, while the S&P is down 5%. So that really puts in perspective how nice it is as a hedge within a portfolio. You don't have to have half your portfolio in gold, right? You can have a low percentage of your portfolio in gold, but it's definitely a nice complement. I think in terms of Wall Street, it doesn't really make money off of gold. It makes a lot of money off of stocks, and we love stocks, and stocks are probably where most people should have most of their assets. But there's not really a lot of incentive within the system to, there are some there are some companies and products that are in the gold space, but to really encourage gold.
One of the things that I wonder and sort of question is whether or not, well, I guess I don't, because I just like gold no matter what. And I look at it right now and I'm like, anytime it's like going below 3,000, or even like 2,800, I think that was my latest one. It was below 2,800. Those days have kind of come and gone now. It's moving up considerably. You have Goldman Sachs now, Rob, saying they're putting a price target of 3,300. I don't know what the answer is. I wouldn't be surprised to see that. I wouldn't be surprised to see it actually be more by year end. And so, again, I'm not looking to get in and out of my gold, but I am watching it as a percentage of my portfolio because obviously with this increase, right, it takes on a larger and larger role. Do you, like me, see that this is going to continue to move forward over the next year or over the next 12 months? I mean, it's still an asset class. I know the answer to this, but I'm asking for the viewer.
Well, look,
Don is joking. He's like, Trish Loves Gold. Yeah, there's a website, trishlovesgold.com, for a sponsor on my other show. But yeah, I think it's one of those asset classes that you're smart to be in, period.
Yeah, the long-term direction of gold is up, right? Because the long-term direction of, fiat money printing is up. And now there is the risk, and certainly we saw it in 2011. The gold price doesn't just go up. The gold price can go down, and in 2011 it went down pretty sharply after a huge rally. So there is the risk that gold could become overextended. I still think we're sort of moving in a direction where gold is becoming just having more value relative to the world's fiat currencies. And the central banks are kind of repricing it. When you think of the tariff dynamic now, and this is sort of feeding into the gold momentum, what happens in a tariff dynamic is that everyone's monetary policy tends to become a little easier because, for these foreign countries to overcome the tariff, they need to
make
kind of
your products cheaper. Mm-hmm.
Yeah, they debase their own currencies. They have easier monetary policy, but then the U.S. in turn has to kind of control its exchange rates, and it starts to get more inclined to debase its, to print. So, if you're in a dynamic of a lot of monetary creation, that's where gold really kind of has sustained upside.
It's again, it's one of those things that I like in a diversified portfolio, period. But given everything that's happening right now and all the tariff talk, I think there's all the more reason for these central banks all over the world to want to own it. And it's one of the reasons why if you look at inflation protection or income builder in our portfolios at 76 Research, we have included it, and a smart thing to do. So the IPO market, it's not what it once was, shall we say. You had a big IPO happening this week. It underperformed relative to where people thought it would come out. It still made a ton of money, right? Raised a ton of money. But this is the CoreWeave IPO that I'm talking about that is a sort of bet, if you would, on AI and the future of AI. And it didn't quite do what people had expected. And were you surprised by that? Or is that just, hey, it was a tough day in the market? People are looking to kind of pull back and they're retrenching a little bit, I think mistakenly so, frankly, from some of these AI investments. But it was that sort of what was going on, or do you struggle to get there in terms of the valuation for CoreWeave itself?
Yeah, I think it's you could look at it as just kind of like an indication of market sentiment. They probably should have gotten that thing out the door 30 days ago or longer. You don't have as much bullish kind of enthusiasm and excitement around AI as today as you did earlier in the year. It's an interesting company. I would just it's sort of, we don't get a lot of IPOs or important IPOs lately, so I think there's a lot of interest in it. I would just mention it's still a relatively small company compared to some of these other tech names with, kind of an enterprise value in the tens of billions. What they do is they basically buy NVIDIA GPUs and sell them to third parties, sort of in like kind of an outsourced model for AI compute capacity. So it's an interesting business model. They do have a lot of debt, something like 11 billion or so of debt that they're kind of looking to address through the IPO. Microsoft is the major, with OpenAI is like the major customer, with a majority of the revenues actually kind of connected to them. So it's an interesting business and probably one that has good prospects, but the market's not as excited about it.
Yeah, where it is. I mean, it's probably worth us taking a really hard look at from a more analytical standpoint, just as we see it, and we'll see what it does this week. If the luster continues to wear off and it's continued to be challenged at some point, maybe it's getting more interesting. I'm throwing you a curveball here because I know we didn't talk about discussing this, but I want to, and Don's in the chat, so it reminds me of Disney because he really hates Disney. I think we all kind of hate Disney at this point. There's a big article that came out today about the FCC's pressure on Disney, and I'm just trying to pull it up here because Brendan Carr, who is the head of the SEC, is now really leaning hard on Disney. I mean, he's leaning hard on all these guys from the public broadcasting services to the big networks. And I'm just seeing if I can find this because he just sent a whole other, he's investigating DEI at Disney. So this is new. One of the reasons you and I started this, or at least had the idea to start this, was our frustration that DEI had kind of taken over Wall Street. And I look at what Disney has morphed into, which is a pretty challenged business, at least from the entertainment side. And I feel like DEI is to blame, big time. I know DEI is to blame, and they got a bunch of DEI woke idiots running things that this article is putting it all out there, saying how they did this, that, and the other, and then they'd have to bring in the old white guys to like revise the scripts because they were that bad, and the young diversity, equity, inclusion candidates that they were bringing in just somehow couldn't get the job done. Everybody's out partying every night. And it's just been kind of a nightmare there at Disney. What do you think can happen to this company and all these media companies as a result of these FCC investigations? I'll tell you, I think they're really scared right now. And I think that they're going to have to change their approach in a pretty massive way. I mean, how is it that these shows that are running on FCC airwaves are able to spin the total garbage that they're spinning and be so insanely biased towards Trump, against Trump, towards Biden, towards Kamala, and like look at you with a straight face and think that's okay?
Yeah. Well, what we really saw over the Biden years was this like intense like politicization of so many institutions like across the United States, right? And it happened in corporate America. DEI is kind of like a continuation or a piece of like the ESG movement, which is all about kind of applying or imposing like kind of these ideological constraints on companies or priorities on companies and distracting them from shareholders. But we, with DEI, we see it, how it just completely dominated, the federal government and the universities, academia. And so now it's like, it's time to unwind this. And we're learning how toxic and harmful it's been. So in the university context, you've got, they're using the lever of federal funding to get the behavior to change and to back away from these DEI agendas. And, I think when it comes to media companies, the FCC is a potential mechanism to go back to
go
kind of
and fix some of
principles
this
of fairness and equality. Yeah.
I'm looking at the chat, like Snow White, terrible opening week, just an awful performance. It was an awful movie, okay? I'm sorry, guys. Like I took the kids. None of us could stand it. None of the kids in the entire, it wasn't even that crowded. I'm like, wow, like even Wicked, which like I didn't love the actresses in Wicked, but it was a crowded theater. Like, it was hard to get tickets, and people were entertained. This one, disaster, like just a mess. Clearly a mess. And then they've had all of these issues and all these controversies, and Rachel Zegler was just the worst choice ever. But all that said, I pointed out to Don in the chat there that may have been sort of the top for DEI and maybe for Disney. But can Disney actually fix this? And so if I'm looking at it at $98 a share, it traded down roughly 2.4% there on Friday. I don't know, like, do you need to clean house? Does Iger have to go? Nelson Peltz, where are you when we need you? He's deserted the place. He made his money and ran. But this is a company that should represent so much in terms of its IP and its legendary history. And it's just, it's like disintegrating into nothing. I mean, I still don't think I'd buy it here at 98.
Yeah, and we've been following it since we started.
And by the way, that's down from 205 or something at one point in 2020.
Yeah, and it just can't seem to get any life back. I don't know. It's sort of one of these situations where, the problems are so cultural and entrenched that it's very hard to fix. And my personal vantage point, I'm usually reluctant to go into, when you want to buy a stock, you want to look for a company that just, you have like a really strong foundation that's healthy. Maybe there are some problems on the edge that are kind of hurting the valuation, but that's an opportunity here. Is it like a diseased company at its core that just can't like get beyond this problem? That's sort of the question.
I think so.
I mean, here we are after that. When was the proxy contest? I mean, middle of
almost a year ago.
A year ago, yeah. And he raised all these issues and said like this, and now we've got this absolute disaster, in the box office with
Snow White, and Captain America wasn't so good either. I mean, I just don't, and it's like sequel after sequel after sequel. There's no sort of originality there. They just want to wokeify all the old stories and remake them. It's really a problem. I mean, I know the cruise business is supposed to be a little bit better, although I took a cruise on Disney recently. I took one 2 years ago as well. And let me tell you, that thing has gone downhill and downhill fast. I'm just saying, okay? It's amazing the things that kids will get you to do, right? But I'm like, it was tough enough 2 years ago, but it's gone downhill, significantly downhill. And I think that they were looking at the cruise division and thinking, this is the only thing, this is their cash cow, right? And theme parks, but hey, the lines at my kids don't even want to go to the theme parks. When I was a kid, that was like a pilgrimage we did every year. We loved the theme parks. But my kids are like, why would I want to do that? You stand in line in this hot line for an hour? No, thank you. Don adding to this, because he has a lot of views on Disney and has been very vocal about them. The problem with Disney is that they are no longer winning in any segment. Streaming is a money pit. I agree with that. And he said entertainment division is wrecked. I agree with that. Parks are going to lose to Universal, and cruises are dead with the next virus. Yeah, I mean, I guess you have vulnerability, shall we say, should there be any kind of health concerns in the future. But I hear you. I mean, I just find this maybe if it went down to 50, I'd get more interested. I wonder if like you could sell off the parts here, right? And kind of be left with something else. Maybe you stick with the parks and your cruises, knowing you have the vulnerability, of course, to any kind of virus that might come along in the future. But those businesses seem to be working still a little bit better. The rest of it is a disaster. And streaming, I mean, their streaming is a total money pit. Don, you're right.
And for the most part, the thing that ties all these businesses together is like that intellectual property and the brand and the goodwill that's just been accumulated over 100 years. And it's like, that's the thing that they just can't help themselves but to, continue to erode that, and it's like, you're like losing people, even the Star Wars, they bought the Star Wars franchise. I grew up, that was very core to my childhood. I love Star Wars, but even, that has been kind of like diminished and politicized, and all these woke themes have gotten into it. I think the Snow White thing is just really, really damaging in terms of like the number of people that are turned off. Maybe these are people who weren't turned off by the stuff they were doing a year ago are now turned off. and it's going to reverberate across all of their businesses.
Don is just pointing out that he shorted it. Would you short it? I'm short from 117.50. He's going to cover at 70. Look, it sort of is symbolic of the whole DEI stuff gone wild. Piece of my mind pointing out that wasn't this sort of the World Economic Forum that really pushed this whole DEI and ESG, and the answer to that is correct. Yes, it is. But that was also the US. I mean, I think about Larry and how Larry was just pushing this DEI, ESG stuff, and why I guess he thought it worked from a financial standpoint until it didn't, right?
Yeah, I mean, at BlackRock, they did a complete about face on it. I recall being like in the office when this stuff was peaking, and it just was driving me crazy. And we would even have things like, we would have Black-owned business lunch day, like where we could only order from Black-owned businesses. And like, look, I love Black-owned. I'm happy. Like, it's great that there's Black-owned businesses, but the idea that you're gonna find out the store that, like, the race of the owner of the store that is gonna sell you lunch and then not buy lunch from a Hispanic-owned store because you only like the idea that was normalized. It was so offensive to me, just the principle of it. But that was like that became like de rigueur across Wall Street and like acceptable behavior. I think that's quickly disappearing, and people are recognizing.
I hope so. But I worry, like, we've scarred a generation of kids, and I think about my own kids. And we used to live like as north as you could live in New York City on Fifth Avenue before you were like officially in the hood, right? They called it Carnegie Hill. And, it was basically Harlem. So Carnegie Hill, my kids would go to the playground and they played with all kinds of kids, including a lot of kids that, were right out of Harlem. And it was like nothing. Like, they never noticed. They didn't care. Like, they're just kids, on the swing set or the monkey bars or whatever. And since then, my children have been made very, very aware, right? Because they've been like indoctrinated at school and stuff. And at one point, one of my little girls said to me, and she was very upset. She's like, Mom, and this was after 2020, right? So you're coming out of everything that was 2020 and the George Floyd stuff, and then they go back to school at some point in fall of 2020 or into 2021, and you're really made to feel this. And so she said, it's so upsetting to me now because I feel like I never saw it before. Like, my friends were just my friends, and she has a very diverse group of friends. But she's like, now it's like all I see. Like, I can't, and I'm suddenly like on edge about it. And I think about, isn't that what we're trying to avoid? Like, don't you want to be a colorblind society? And this whole movement from Wall Street, the World Economic Forum, from Disney, from academia, from maybe the Europeans, it was really destructive in ways that are very anti-American, because in America, that's why everybody wants to come here, right? We don't care what color your skin is or where you came from or who your family is. This is your path to success that is very unique. The American dream is unique to us because it is colorblind, because we don't go out and order lunch from some specific restaurant because it belongs to such and such family or has an owner that happens to have a certain skin color. I mean, that it's just so, you're right, offensive and wrong and not who we are. So the quicker we can get away from that, back to the meritocracy that has made us the strength of the world, the better.
Yeah, all of these things are united, and it's sort of like going back to this emphasis on individuality, and that's what's so great about America. It's like really kind of starts with the individual, the rights of the individual. And it doesn't matter what your tribal affiliation is or your appearance or even, your how you were born, right? It's like who you are as a person. That's what America's all about. And, the good news is, I think, is that you do see, you mentioned your kids. I mean, you do see young people are gravitating to that message of emphasis on individuality, getting away from the identity politics and, sort of defining yourself based on your various affiliations. It's probably why Trump got elected. I mean, you saw the surge in the youth vote, that was unprecedented for Republican candidates.
Sure. And a lot of the youth vote is all, it's just amazing how how conservative I think a lot of people have become in this moment in time. But this gets back to, again, you've got to be able to like understand what's real, what's not. It's not going to work for Disney if this is their future and this is what they're clinging to. I'm sorry, like they're going to really, really have to change things pretty darn significantly in order for things to change. It's good to see everybody here. I know it's a Sunday night, so I appreciate everybody tuning in. It is we got some regulars from the Trish Regan channel. I encourage everybody, if you're watching for the first time, please make sure you subscribe, share, like, go over to 76research.com, use our code word dollar. You can get the report there for the first 2 months anyway for just $1 a month. Cancel anytime. You should check out the portfolios because look, we're beating the S&P and we're pretty smart. I don't want to toot my own horn too much, but like I think we're a good combo and a good team. Me having seen how the sausage is made, so to speak, from the media front and the financial media front. You've seen it from the investor standpoint, having run billions of dollars. And I think that it's an amazing thing to not have any, like I say this all the time on my channel, on my show, the Trish Regan channel, like I don't have to worry about management and big media and all the headache that comes with that and the biases, right, that they expect you to deliver. It's just sort of me and the viewer. And what I wanted to create with you was the opportunity to do that from a financial perspective. A lot of people know me on that show and they don't know necessarily my deep love of markets and finance, but that's sort of how I started. And we need to be able to be as transparent as possible without the biases that come from working for a firm where you're promoting this, that, and the other.
Yep. And it's like really only through the magic of these like internet platforms that we can really, have the reach and operate in a way that is totally independent, where we don't have to worry about the agendas, whether they're political or not, of our kind of the corporate overhead, right? Or the corporate entity in which you find yourself. So exactly.
So here we are. So make sure you subscribe, get the newsletter. Let us help you in any way that we can, because I wouldn't bet against Donald Trump and I wouldn't bet against America right now. I am long America, always. Peace of my mind. Indeed, we are the United States of America. We'll leave it at that. I'll see everybody back on the Trish Regan show. And please make sure you sign up for 76 Research. Go to 76research.com. Use code word dollar. We will see you. I will see you certainly on my program again live tomorrow.